I'm Alix, and welcome to Bloomberg Commodities Edge. It's 30 minutes focused on the companies, the physical assets, and the trading behind the hottest commodities with the smartest voices in the business. Let's first kick it off with Spot On, our expert and investor take on our big story. And this week's big story, President Donald Trump's decision to pull out of the Iran nuclear deal.
In just a short period of time, the world's leading state sponsor of terror will be on the cusp of acquiring the world's most dangerous weapons. Therefore, I am announcing today that the United States will withdraw from the Iran nuclear deal.
Joining me now is Chad Brownstein, the CEO of Rocky Mountain Resources, who calls $70. I thought he was crazy. And Richard Nephew, senior research scholar at Columbia University's School of International and Public Affairs. Richard formerly worked at U.S. Department of State and was involved with the Iran and sanction negotiation. Guys, welcome. Good to see you.
Thank you.
So, Richard, what happens to Iran's production and exports?
Well, I think at least for the near term, nothing really changes. The Iranians have absolutely every incentive to try and put as much oil in the market as they possibly can and to keep those numbers high while the U.S. gets its Sanctions Act together.
But they can work around it?
I think they can. I mean, first off, they've got an advantage that the rest of the world didn't want us to do this and may be helping the Iranians to evade sanctions and to resist them. But I think in the end, the Iranians are going to have some export losses. It's really just a question of who are they going to find to buy up that extra oil, and will they offer discounts to do it?
And will they wind up actually finding those buyers like you mentioned? So I wanted to pull a quote, Chad, from the Treasury issuance that came out earlier that said, whether the price and supply of petroleum and petroleum products produced in countries other than Iran is sufficient to permit purchasers to reduce significantly in volume their purchases from Iran. It's an addendum to that potential reduction in imports. How tight is the market then?
Well, today we're tight, but the story really coming out of this, as Winston Churchill said, you protect your most important truths with a bodyguard of lies. And the truth today that came out with Israel fighting with Iran is that the Saudis, the U.S., and Israel are the new axis of the oil economy, integrating to work to where the Saudis will deliver their product to the east. And I'm making a call for 2028, the U.S. will be effectively energy independent. And you said at 70, I may not be right, so maybe I'll go 2 for 2 with that.
So energy independent, what does that mean for the oil price? Bank of America has a potential $100 call depending on what Saudi does.
I think we have enough production now and enough rigs up. 15 and 16 year over year was the first time since 83 that we had year over year destruction of production in this country. Mm-hmm. And for the next 5 years, I see rig growth, I see institutional dollars put to work, and a lot of it's equity dollars. You know, the leverage ratios are down 85% on forward loans that are going on in the market today. Mm-hmm. So you have a big equity component. The drillers are well financed. You got a 5-year program running in front of us. We're going to have a very tight market. It's going to hang around 70 for an extended period of time. And then when the independence comes between the two regions of this world, you're going to see a differentiation between Brent and WTI.
Okay, so let's get to what can make up what. So the U.S. is not going to be able to make up necessarily what we lose from Iran. There's a lot of questions as to what Saudi Arabia's spare capacity actually is. Richard, what do you see it as?
Well, I think at this point, the Saudis have been making it very, very clear that they are most concerned about market share. And so in terms of actual numbers of the spare, it's kind of unclear how much room that they've really got to go, because they don't necessarily want to use all of that room if they can instead deal with other producers. And that especially counts with the Iranians. I think their objective with all of this with the Iranians is going to be to edge them out and to damage them geopolitically and make sure that their economy is as damaged as possible.
Meaning pump more lower prices.
Absolutely.
So we got a tweet today from the Saudi energy minister. He said, I'm in close contact with OPEC's presidency, Russia, and the U.S., and will be connecting with other producers and major consumers over the next few days to ensure market stability. What does that mean?
He's just protecting the Saudi Aramco IPO in the coming months, because the reality is that the world is confused. They don't know if the offline or online product of Iran is actually in the markets yet or will affect the prices. So he's trying to stabilize and buoy the current prices, which benefit them considerably in today's markets.
You buy it, Richard?
Well, I think that's right. And I think that we're now going to start to see the contradictions and disagreements that have already been under the surface here start to come out between long-term Iranian, long-term Russian, long-term Saudi interests here.
So you laid out your big thesis, Chad, and that has implications sort of you're going to see above 70, but it's not going to be the kind of huge range that we necessarily saw, right? How do you invest with that? What's your big call right now?
Well, the most exciting part about the U.S. possibility of energy independence by 2028 is the infrastructure that's going to be built in this country. So if you imagine that oil is going to be consistently plus or minus around the $70 mark, building terminals, rail, infrastructure, aggregates, the real inner workings of the roads that build this country are going to be the most exciting parts of the infrastructure related to creating value. You're going to get cash-on-cash yields in the mid-teens today in the aggregate space.
Are you talking like MLPs, or are you talking to something more basic than that?
More basic than that, fundamental growth of the roads and the infrastructure, bridges, tolls. But you're also going to see terminals being built. You're going to see Mississippi River terminals. You're going to see Louisiana terminals, Florida terminals. Everything that goes to energy infrastructure, as well as aggregates and infrastructure related to building it.
Richard, what's your biggest question you have right now?
Well, I think it's going to be where the Europeans are going to come out on terms of Iran and their imposition of sanctions. They've said very clearly they intend to push back on the U.S. decision to walk out of the agreement, and we have to see what that looks like. Are they going to actually introduce legislation that allows them to push back and even retaliate against the United States or not? Because that will drive a lot of things, both politically and diplomatically with the Iranians and economically as we look at things like, for instance, oil supply.
Guys, thank you so much. I really appreciate it. Let's take a look at your takeaways right now. Chad sees a new world oil superpower, Israel, America, Saudi Arabia, and he's investing in infrastructure and some gross land positions. Richard does think that Congress could consider increased sanctions. U.S. partners may retaliate. He's watching Europe. Chad and Richard, thank you so much. It was a real pleasure to be with you guys.
Thank you. Thank you.